And we are live. Welcome to another episode of Unscripted. And I have the great pleasure to reintroduce David Addison, who's my favorite cyber insurance guy. Thanks very much for joining me today. How are you?
Yeah, thanks for having us, David. Happy Monday.
Happy Monday indeed. So, reason why I wanted to have you on the show today is I came across this phenomenal, and we should give the credit when credit is due to this info chart, cyber insurance data by businessinsurance.com.
Yeah.
And whenever I see something like that, I would suspect that most of the people would just glance over it and just, it's really hard to really get the net of what this means because it's absolutely packed with information.
There's a lot there. There's a lot of information there.
There's a lot there to unpack. And I couldn't think of anybody better than you to unpack this information, because most people would look at it and then with googly eyes and trying to figure it out. And it's impressive. So why don't we get started? First, let me ask you this: what are we looking here? This is mainly biased towards North America, right?
Sure, definitely. It's Business Insurance is one of the top insurance publications here in the States, David. So I'm not surprised that it's North America focused. I got really dark here.
Yeah, that's like you gotta turn on the shades. So let me ask you this: why is that? Is that because we are a litigant in North America? Or is it more insurance requirements, more
So
compliance?
I'd say it's twofold, David. One, we're just a prime target for hackers, geopolitically, intellectual property, theft of funds. We are one of the wealthier nations. So I think we definitely are a target just in terms of how cyber criminals are able to effectively monetize their cyber attacks versus attacking other countries. The second reason is, I think, more aligned with what you've said, which is we are a very litigious society. And if your audience will remember, cyber insurance started off as a privacy liability product where it would pay your legal costs and expenses arising out of your failure to protect confidential information. Before ransomware, before extortion, before any of that sort of became the headline topic of the day, it was truly indemnity from third-party lawsuits arising out of data breaches, right? So being that this market has always been a leader, the North American, specifically U.S. market, has been a litigious environment, and the fact that we're target for cyber criminals just on the basic set that we're the wealthiest country in the world, it does make sense that this would be focused on us. And the insurance market generally, David, just keep that in mind for the audience as well. The insurance market, the United States is the biggest insurance market for any line of coverage generally, or almost any line. Property, casualty, public liability, all of that. We're just a huge country with a huge footprint and a lot of lawyers.
And it's funny because you are spot on. It's never a single variable. It's always a combination of things. In this particular case, it's like almost a perfect storm, as you described. And let me ask you this: it's also, from looking at the chart, and I'm looking at it right now, I'm going to post it off for the audience to see if people are not familiar with this. The overall market share for the top 20 cyber insurance went slightly down from 2021 to 2022. Is that because of new emergence into this space? What do you think that is?
100%. So I think we talked about this briefly on the last video that we did, David, but in 2020, on the backs of the pandemic, for those of you that remember that, and SolarWinds and the Microsoft Exchange vulnerability that came out, the cyber insurance market went into a panic. The not so technical term is called a hard market, where premiums go up, limits go down, deductibles go up, and the breadth of coverage goes down. So from 2020 to 2022, we had multiple different factors impacting the insurance market. Premiums went way up to address the losses being paid. At the same time, policyholders were being required to improve their cyber hygiene to a level that had never happened historically. So if you wanted to renew your cyber insurance, David, MFA, EDR, backups, all of it had to be in place, and you had to prove it anymore after 2020. At the same time, the Russia-Ukraine conflict in 2022 resulted in, quite frankly, that part of the world pointing a lot of its cyber guns at each other. And so we had a very quiet year in 2020. From 2020 to 2022, claims and losses and ransomware attacks have come down dramatically. That has enticed a lot of new entrants to come in. So the way that the insurance market works generally is when a coverage gets hard, in meaning that there's less capacity, less coverage, it usually gets to a point where it's so hard that other people come in and say, holy crap, we can make a lot of money here, and we're going to enter the space. And so from 2020 to today, still now, David, you see a lot of new entrants coming into the market trying to compete with some of those very healthy premium dollars. That, I think, is the most logical explanation in terms of why the top 20 are not writing the same amount of business. There are insurers from the small business sort of 25 million and below revenue target clients that are popping up everywhere. And then there's a lot of other businesses, specifically Lloyd's of London syndicates, that are popping up and starting to write the Fortune 500 as well. So these guys sitting in the top 20 are facing some stiff competition from other people who want to collect those premium dollars, which, by the way, eventually leads to a soft market, which, by the way, eventually leads to a lack of underwriting discipline, which, you guessed it, eventually leads to a hard market. So the whole thing is cyclical.
It's good for people like yourself since you're riding that wave. Now, here's a question. At what point in time will potentially the government step in? Because they do. At some time, when they say, okay, it's just like a flood insurance, right? They realize that flood insurance is too costly for policyholders to maintain. And so the government stepped in and said, okay, let's create this fund. FEMA is insuring at a kind of quote unquote lower cost, and because otherwise people will not have insurance. It's not feasible for them. Would that happen potentially to cyber?
So that's a really good question that's being talked about in sort of discussions within the brokerage community and definitely within some of the larger insurance lobbies. Yes, we have our own lobbyists, which is a different discussion. Flood insurance, earthquake insurance, and to some extent the TRIA, Terrorism Risk Insurance Act after 9/11, were very much based on a concentrated area of risk geographically, right? Homeowners insure, look at California, for example, right? The earthquake risk and the wildfire risk is so severe that it's very difficult to underwrite the risk. And so it's very difficult for people in that region to get coverage. And so the state regulators and sometimes federal regulators will step in to offer coverage that the insurance market cannot because they can't profitably underwrite it. In the topic of cyber insurance, geography goes away, right? And so underwriters are actually more worried about concentration risk within the top 25 or top 50 or top 100 vendors that people rely on. Couple that with the potential severity of nation state attacks, and you absolutely have an uninsurable exposure, right? So if one of our political adversaries decided that they wanted to take down our economy, they could, right? Those nation states have the same power that we have, and I think there's an element of mutually assured destruction. Insurers are unable to cover the entirety of the dependent business risk of, say, AWS or Microsoft Azure or JP Morgan Chase payment services, credit card, banking, wires, all of it. It's just too important and too big of an organization. And so what you have now is a parallel conversation where insurance companies, much like fire and quake and hurricane or flood, are now starting to put on widespread event exclusions, where if Amazon went down globally, it may not be an insurable event under your policy, or they might be putting on nation-state war exclusions, which we've also talked about, David, which basically state that if a sophisticated enough nation-state attack occurred that by the terms of this policy, which vary greatly, so we always go back to the coverage matters, if a nation state attack occurs that is crippling enough to the nation, we're not going to cover it because it's an act of war. Because both of those events, AWS going down for 48 hours, or one of our political adversaries deciding they really want to make it hurt, it's probably going to bankrupt the entire the cyber insurance market if everyone who had coverage needed to be reimbursed. And so the coverage in that specific area is absolutely shrinking. I'm not saying that it's impossible to get coverage, but it's important that your audience understand that they need to be aware of their war exclusions and their widespread event exclusions. Simultaneously, people are really starting to make noise with law enforcement as well to say maybe there should be a federal backstop for a catastrophic event like a nation-state attack bringing down the entire country's payment system or power grid or what have you. So, yes, the risk of a nationwide cyber attack is uninsurable. I can tell you, there isn't enough money to make everyone whole. Sorry. And so how do we address that?
And it's getting, and it's getting complicated. In a sense that for flood insurance, there are all kinds of stipulations. First and foremost, you have to prove, for example, that there's more than a cluster of homes that got hit. It would be the equal, and the reason why I'm providing the equivalent, so because it's easier for people to understand.
I agree with you. People understand their personal insurance better.
Yeah, and then I think you also, in order to get coverage, you have to get coverage 30 days in advance. So you can't. You hear on the radio the Hurricane X coming, and say, okay, let's. You can apply that to cyber insurance as well. There's going to be some stipulation associated with this type of coverage, right?
There's always that type of stipulation on commercial insurance, David. Most policies for commercial insurance have a clause that state that if you knew of an impending event, or if you knew that you have a intrusion in your network, or for some of the worst policies, if you should have known that you had an event, the policy might exclude coverage. So that's already in there. From a commercial insurance perspective, David, they really don't. They're really not. They're not. They don't insure a burning building easily.
You should have known.
Yeah,
that's all. That's a kind of catch-all phrase, no? Like it's very broad.
Terrible. I see it in policies, man. Like I don't accept it from my clients, but I see policies, David, where it says if the CISO knew of an event or reasonably should have known of an event, the policy might be voided. It's there. It's out there.
Sounds like a litigation waited to happen over a period of several years just to prove that.
It would be a horrifically ugly bad faith claim to the insurance company if they played that card, especially if there was no bad faith on behalf of the policyholder.
Yeah, and we've seen that. We've seen this in the news. Again, the nation state, we talked about the fact that the proof of actually proving what does that mean and to prove that it was a nation state and not potentially a commercial enterprise out of the eastern countries. There was a commercially, maybe it was backed by a nation state, but maybe it was
exactly.
Who knows? There's so many like ambiguity, which is because that's the issue. I think that most risky, pun intended, for any kind of policies to have a lot of these ambiguity built into the policy.
Can I make an observation about the chart that you want to talk about today as well? For the audience, when you look at this chart that David's going to send you, the top left quadrant of the chart talks about U.S. domestic surplus line, U.S. cyber insurance market by type. Alien surplus lines, U.S. domestic admitted, U.S. domestic surplus lines. Anything that says surplus lines, David, means that the policy forms itself, the policy wordings, have not been reviewed or approved by a regulator. You're on your own. So in terms of coverage disputes, in terms of insurer insolvency, you're on your own. Most commercial enterprises buy surplus lines surplus lines insurance every day. It's not a bad thing at all, and it's important that I differentiate that. But to your point about tough terms and conditions or gotcha clauses, it's a lot easier for insurers to insert those clauses when their policies are not regulated by a local insurer. And we saw after 2020, because the cyber insurance market is so unstable, the huge shift from the domestic admitted insurers to U.S. surplus lines insurers. And it might be the same company. It might be the same AIG. It might be the same Travelers. But instead of filing their forms with the insurance regulators, in all 50 states every year, they've said, we're not going to do it anymore. And so they've moved to an unregulated insurance vehicle or insurance company so that they don't have to file those forms. So when you talk about changes in terms and conditions, it's a lot easier to make those changes quickly on the fly to respond to nation state situations or widespread event exposures when you're not admitted because your policies aren't regulated.
And are the customers aware which policy they're getting, whether it's surplus line or regulated?
Almost every state in the union requires some sort of notification to the policyholder on the binder of insurance that this is a surplus lines policy. Secondarily, to the audience in the room, if you are paying a tax, a surplus lines tax on your insurance, you're buying surplus lines insurance, okay? You should know whether you're buying surplus lines insurance or not. Not because it's bad, like I said, but because you should know. Because if you try to go get help from the regulator, is going to say, you're on your own.
Yeah, it's probably similar with the FDIC insuring bank accounts.
Excess of a certain amount. Yeah, 100%. It's not avoidable. It's a real thing that exists. I'll tell you what, high quality earthquake insurance in California is guaranteed to be surplus lines. So it really serves a purpose. And it's usually higher risk insurance.
Yeah, and sometimes you don't have a choice.
Correct. Exactly.
So if you come back to the chart, I also look at it and it says it looks like that there's a steeper increase in total losses from 2018 into 2022. What does that tell you from the standpoint of maturity of these cyber threats in these past several years?
I think it's a number of different factors, and this is based on all the discussions I've had with the incident response firms and the coverage council, right? So one, there is a larger uptake of cyber insurance buyers since 2018 to 2022, big time. And so you just have a better reporting scheme in place, right? A lot of people, when they were attacked before they had insurance, they would just kind of deal with it on their own and make it go away, maybe just wipe the whole network and start from scratch.
Yeah, so would not show up here because they were not insured at all.
Most insurance policies now require that you liaise with law enforcement, especially if it's a ransomware situation or a theft of funds situation. You're probably going to be contractually required to get law enforcement involved. And so you have an increase in folks who have an obligation to self-report. I think you just have a constant barrage of threat actors trying to get in as well. You can see the uptick sort of really take off in 2022, and I think that leads us to what happened in 2023, which was the worst. 2023 has been now, the books are closed, the worst year of cyber losses of ransomware claims paid in the history of the coverage. It's just not on the chart yet. So I think it's just a normal course of things.
Yeah, and then also it looks like the California, Florida, and Texas, they list the number of victims for the victim losses for cybercrime. And are these specific states?
You're talking about the most important economic states in the country. If you look at the victims, you could probably almost also align them with how successful their businesses are or what their GDP is, right? California, how much intellectual property is sitting in California? How much wealth is sitting in California? Same for Florida, Texas, New York. You might say that the flip-flopping of New York and Texas and other states is because certain states have been a little bit more strict and stringent about prescriptive regulations, like the New York DFS for having a virtual CISO and MFA and encryption, right? I don't know if you can attribute that, but when I look at the top of the list, David, it's obviously to me that these are the most valuable targets too. You can move New York or Texas or Illinois, but there's still, how much information is sitting on the servers in those states?
Yeah, maybe there's more of a brick and mortar businesses in West Virginia than there is in California, obviously.
Yeah. But you have so many headquarters, right? Corporate HQs sitting in those top 5 states where really the network topography, the crown jewels are probably there too.
And not surprisingly, phishing is one of the top areas of concern. And it's crazy because again, phishing's been around for such a long time. Business email compromise. We seem like we're now better off than we were back in the 2000s. Like it just doesn't make any sense that we haven't yet.
I think it's really funny. I saw that chart too. The bottom of the chart, the cybercrime types. Phishing is the #1 type of cybercrime. I think it's really funny that they broke it out like that because phishing is also the way that they get in order to commit a data breach or a ransomware attack or to commit some sort of spoofing. So phishing is like the gateway drug, for lack of a better term here.
And it's also a catch-all. I think if they don't know what it is, they just say it was phishing, right?
Yeah, because you know what? It's really hard to break into a network. It's really easy to get someone to open up a file.
That's right. And also the business email compromise where they get an email, spoofed email, or man-in-the-middle attack where they get an email from supposedly an executive to wire some money.
And I saw 24 on that list was really interesting. SIM swap. The death of SMS MFA or text message multi-factor authentication, I think, is imminent because if you can duplicate someone's cell phone, the text message that the counterparty is sending you to that token for the multi-factor, it can be intercepted. So,
yeah, and you'd think that they have when you call T-Mobile, for example, there's a 6-digit code that they ask you for. And I have to tell you, I always forget what it is because I set it up 2 years ago and I don't typically use the same one. Yeah. And so I have to get them to authenticate me some other way, which is a much easier way to just ask for some credentials. And then that's the problem. Like and I also think they have insiders. I'll be honest with you. Like I think they have insiders working with these companies that they get some kickback for SIM swap. It can be lucrative business, especially on the cryptocurrency.
I just started watching. This is gonna really get some eyebrows. I just started watching for the first time The Sopranos. There must be some organized crime element in that too. Come on, it's just when you've been SIM swapped, so many different identity controls have failed that there has to be an insider. I think. You can't even walk into an AT&T store without someone asking you 10 different questions to verify your identity. The only way I think you get through that, David, is if someone really wanted your identity.
Yeah, and you think that the organized crime would also not stand still and they'll move into the digital age, right?
Of course. They got to make money too. They got to put kids through college.
And then it's no surprise that it looks like it's evident that poor cybersecurity practices is the cause. It's almost like, okay, this is a bit of a Captain Obvious of a chart over here. And again, we talked about the cyber insurance forces, some practices to be put in place, like MFA and least privilege access and all of that. But there's still companies that are so behind in the basic hygiene in terms of network security and security in general.
Yeah. I would agree with that. I think especially, David, with the 100 million or 50 million in revenue and below, these are very tedious and difficult network security tools to implement. If you're a one-man shop, if your IT team is you, and you have to implement MFA and deploy a backup solution or deploy some sort of endpoint detection. So we are still seeing companies in that space lag, although I will say that most of the people that I talk to in that space are the most aware of how vulnerable they are, which is a really good first step. And the second thing is a lot of the new insurers that are taking business from that top 20 we talked about are bundling security products and services with their premiums. And I think on the whole, that's for the best. It's not my ideal situation. I don't necessarily want my insurance company being the one controlling my protection, but it's better than nothing. Everything is better than nothing.
So the first step is to admit you have a problem.
Exactly. Yeah. 100%.
But do they? Or it's hard for people, for especially the ones that are in charge, to come back to the board or people that are responsible, the CEO of the companies, and say, because they typically answer to them and they say, okay, are we secure? Yeah, we're secure. We're doing everything we
You
need to
know
do.
what? I'm gonna disagree with you, and maybe this is because we have a disparate data set because we have clients who want to buy cyber insurance and therefore are probably more educated generally on cyber insurance. Most of the time, when I have a company or a client, excuse me, that's lacking the controls, it's because either the value of those controls has not been communicated to a finance stakeholder or to an audit committee correctly, or they're just not able to afford whatever widget, MFA, EDR, because it's too expensive for them. I wouldn't say that it's a result of the CISO or the equivalent person saying that everything is fine, don't worry about it. I think it's more along the lines of either communicating the importance and value of adequate cyber hygiene or finding the budget for it, which is it's always tough. It's always tough. We can have a client who's rolling in cash in the black, no debt, and it's still, do I want to spend money on cybersecurity or do I want to spend money on R&D for our next product?
And there's limited funds for dealing with infrastructure and running the business. And
Exactly.
the
Exactly.
cybersecurity piece is a sliver of that.
But I will also tell you on this chart about poor cyber practices, which a metric that isn't here, probably because they don't, it's difficult to track. The severity of the attack also goes up big time when there's poor controls. There's less safety belts, there's less airbags, there's less points that can stop the attack from spreading or being catastrophic. So the other thing that happens, not only are you a target if your controls are not good, because a lot of times they can see whether you've even patched the software on your publicly facing domains, but also it tends to be a lot more severe if you don't have controls, much messier to clean up.
And speaking of publicly available information, do companies, insurance company, rely on ratings like OSINT, open source intelligence ratings, that do an outside in look? There's a bunch of companies. I'm not going to name names. So we haven't. There's no sponsor for this
Yeah.
particular.
Yeah, yeah.
But what's your take on that? Because there's a lot of companies now they rely on that not just for themselves, but also potentially for third parties.
So that's a really good question. And yes, insurance companies use ratings models. Some of them use multiple ratings models. Some of them are a mix of the different companies that you just alluded to, David. And some of them have their own internal risk engineering teams that will have their own raters. But companies are scoring applicants. And usually the scoring of an applicant for cyber insurance is going to be a scoring of their ransomware preparedness, which is probably a 30 to 50 question ransomware supplement, and a scoring based on a third party or their own proprietary external scan to look at your open ports, to identify whether or not you've patched everything that's visible, to see how your third party vendors that you trade with are increasing or decreasing your vulnerabilities because you might be trading with someone who's got poor hygiene as well. So ratings are absolutely used 100%
And,
when you
and
buy cyber insurance. Your broker, here we go back to this again. Your broker should ask your underwriter for a copy of the rating, because if they're looking at something, if the insurance company is looking at something and deciding how they price it, you should have the right to be able to say, this is a false flag, this we know about and we're working on. This is something that we know. I've had, especially the large Fortune 1000 companies, David, they're just covered in false positives, right? I had a client who was a healthcare company, and because of their name, when they were doing the underwriting scans, they were associated with a sports team which didn't have good controls. And had I not asked to review the report with the client, we would have had gone from like a B plus to a D minus in scoring. And yes, insurance companies are using scoring systems to price your risk. And yes, your broker should be getting you a copy of that scoring as part of the negotiation with the underwriter so that you know what they're looking at.
yeah, and David, that's why you need somebody like yourself who even understands what it is that they're looking at. Because
I
again,
would,
it's the
yeah.
ratings. And you just provided a couple examples, but I would say there's tons of other more where you get incorrect ratings. For example, a shared infrastructure has some
All the
issues.
time. Oh my God. If you're on the cloud, forget it.
Companies have malware labs where depending on what type of business they're in. So they have labs that actually specifically
Yeah,
exposed to the outside world. To
yeah,
they have honeypots where
exactly.
they
I was
were
just gonna say someone else's honeypot could be your red flag. Just be big time. It's a big thing that companies should be aware of.
yeah, and all of that needs to be reviewed. And then if you are in the negotiations stage, then you can affect the what it is that
Big
they
time.
review and what they take into
Big
account
time.
when putting the policy in place.
I'm telling you, it's huge. It's probably 20 to 30% of your pricing. The underwriter has the authority to override the rating. The underwriter has the authority to make exceptions. But if they're seeing something glaring, they're going to take advantage of it, right? So it's important that you understand what they're seeing as well, to your point. Big time.
So looking at this chart, and we talked about the fact that the following year, we just closed the books, is even worse. So we're gonna have probably a new chart like that. What do you see as a wrap up? Are they any types of new policies or new clause that are, again, we talked about the fact that the cyber insurance industry as a whole is a fairly slow moving industry, but they're also there to make money. So they're
Yes.
adjusting quite quickly to the current conditions. So do you see any types of, you always discuss the increase of premiums, but
Yes.
what else is changing from a policy perspective and coverage?
Yeah, so I mean, for the audience, I would say this year, 2024, might be a really good year to take your cyber insurance out to bid. There's a lot of competition. The market is still very comfortable with where their pricing is, even with what happened in 2023, David, because while we saw 1.75x increase in attacks and losses, it was still almost an average of 3x on premium. So we're in the black since 2020, still as an industry. 2024 might be the year where you renegotiate your coverages with your carriers, especially if you lost coverage a few years back and have improved your cybersecurity posture in the 36 months since 2020. At the same time, when you look to improve your coverage or take it out to bid with your broker, here's a couple things that the audience should be aware of. One, you should be aware of any sunsetted software or unsupported software exclusions where if you're running, I don't know, a Windows 7 server, one, why? But two, your insurance isn't going to cover an attack resulting from that server. You want to keep an eye out for any failure to patch exclusions, especially around 0 days, where some insurance carriers, some of them in the top 10 list, I might add, are putting on exclusions on the policy that state if you don't patch something within 30 or 60 days, you're only going to get a smaller percentage of the insurance that you bought. And then you want to make sure that your widespread event exclusions, which have gone from public utilities and power and telephony to include exchanges, market makers, payment processors, national financial institutions, cloud service providers, internet service providers, those are all now potentially excluded under widespread events. So you want to look at that. And you want to look at your war exclusion to make sure that you're comfortable with it. To your point, when we had our last discussion on the Mondelez claim, um, the lack of specificity is what basically led to a very healthy settlement. There is no longer a lack of specificity on the insurance policy, so the insurance company can dictate in a very precise way how they decide this was an act of war and therefore exclude the policy. So, four things again for the audience: sunset of software exclusions, failure to patch in a timely manner exclusions. You want to look at your widespread event exclusions that might be coming onto the policy this year, and you want to look at your war and active war exclusions. Other than that, this might be the year, I think, to take it out to bid and see what you can do on the coverage.
So it's becoming, what I hear is becoming a buyer's market. That's,
I dare say.
and I would say there's never a bad time to buy. If you look at the apply the real estate slogans, there's always a good time to buy. So you need cyber insurance. There's no two ways about it. You can't do business without it. I think that's companies that
We
are running
we
naked.
expect that we expect that 1 in every 5 to 1 in every 20 companies will be hit in within a year on our books statistically. The question is, how severe is that hit? but we expect that 1 in 5 to 1 in 20 will have some sort of cyber attack. And so those are much steeper odds than a 1 in 100 flood or a 1 in 500 year earthquake. It's a whole different ballgame in terms of frequency. And so we are seeing the policies really step up when people get hit. And so to your point, it's always a great time to buy cyber insurance because right now the attacks are still increasing and the policies are really paying. Just it's important to know what you're buying. Big time.
And I would say also the once in 100 years or once in a 500 years, it's a bit of misleading because people understand it doesn't necessarily mean that you're going to get hit only once every 500 years. You'd be surprised just when you go to a casino and you can have
good night. You can also have a bad night.
You can get hit twice in the same year, even though it's 1 in 500. And the same goes for cyber. We've seen that companies got hit, and 2 months later they got hit again.
Oh, statistically, if you're hit, you're way more likely to get hit again, especially if you paid a ransom. Especially, you don't think the bad guys talk? Give me a break.
And I think I don't know if I asked you this, but do cyber insurers have almost like a Bitcoin fund to pay it, or they just
there are vendors with Bitcoin wallets that act as the payment facilitator. Insurance companies, both from a regulatory perspective and just from a larger sort of balance sheet risk perspective, don't really want to get involved in the trading of Bitcoin. So there's usually a vendor, David, that will facilitate the purchase and payment of Bitcoin in order to effect a ransom payment.
Yeah, it makes sense. Okay, that was very beneficial. And for those who listen to this today, there's going to be a recording, and I highly suggest rewind and listen to David a couple more times, especially those summarizing those 4 points next time you're going out to shop for your policy. And for those who want to reach out and contact you for more help and just getting additional insight, what's the easiest way?
Yeah, you can either go to woodruffsawyer.com and you'll find me right up there in the insights section, and you can see my blog, the cyber blog, woodruffsawyer.com, or just type in David Anderson, Woodruff Sawyer in LinkedIn, and I should come right up. I'm happy to help.
Fantastic. And for all those who joined, thanks very much for joining us today. Much appreciated. Looking forward to seeing the next episode. And until then, stay safe online as well as offline.
Thanks for having me, David. Good to see you again.
Thank you very much.